questions? That's the second form, yes.
But whether they will have a first form, like the specific performance?
Yeah, well, this depends actually on the jurisdiction which guarantee is done. I mean, I think there could be an issue under English law. You can guarantee specific performance, but only secondary claims, money payment claims, but not all jurisdictions treat that the same. So it's also possible that German law you could give a specific performance guarantee, even if the parent company would technically not be able to procure the completion. That would also then come down to secondary claims for breach of the guarantee, but it is possible.
Possible for the parent company to,
Depending on the jurisdiction.
how it did in practice before, sometimes they.
Well, I mean, sometimes a question of money, sometimes it's a question of hiring another engineering company, yeah. I mean, they don't have to do it physically themselves, they can
They will
procure.
try to solve this problem instead of on behalf of their
Yeah.
staff.
But the important point is actually that, as you will see when we talk about security, also the claim under the performance guarantees are of course assigned to the banks as collateral. So as long as the parent company is obliged to procure that the project is finished, they have a secondary damage claim against the parent if this doesn't happen. And that comes then very close to having a guarantee of the loan to begin with, which I think you are right is the more straightforward way. Just giving a guarantee of the loan, and that will make the banks comfortable that they have just a parent risk before the project is completed. And if completion never happens, they can just go to the parent and ask for repayment and cancel the loan agreement and get out of the deal.
Because in the online there someone said that the bank only the lender only care about the payment, but not you don't need actually to have that security. So if what you want to pay, I guess they only get the money back.
Yeah, it's possible. I mean, you can negotiate all kinds of ways. You can have a grace period if you don't reach it by a certain date, and then the parent can procure it. And it really depends on when the banks can walk away from the deal. Yeah, but I think it gives the banks the same kind of comfort. But I agree with you. Technically, it's more straightforward to have a payment guarantee. So.
Last time at the end of the last year, I mentioned the contract response. It's a unconditional payment during the performance of the contract, right? But who will issue the bond? Because the bond is typically the company or a bank will issue the bond, and the investors will give the money first. But if they give the money first, why there is an unconditional payment after that? Because the mechanism that I mentioned is like a sort of a letter of credit.
Yeah. I mean, bond has different meanings. We're not talking about security traded on the market. Yeah, it's the same word, but it has a different meaning. A bond is something like a guarantee, a bank bond in that context. Yeah. And remember what I said about the purpose. The purpose is, first of all, to get the money quickly, and second is to avoid calculation of damages. So you would normally have an agreed lump sum, liquidated damages for the bond. And technically, the project company is the beneficiary of the bond. So if the EPC contractor is late in finishing the project, and you have a certain penalty for the extra days that are needed, the project company can simply go to the bank of the contractor, because it's basically the bank of the contractor that gives a credit to the contractor by providing the bond, and can ask for payment of that penalty. That's it. But it's not the banks that finance the project. It's a different set of banks. I think when we have this picture, you can see that there's different banks from the senior lenders in that picture. Now these are the contractors banks. And provide the okay, basic terms of a loan agreement. As I mentioned a few times, loan agreements are very technical documents. The ambition nowadays is to make them self-contained. Self-contained means that you find an answer for almost every possible question in the financing that can arise during the term of the loan in the agreement itself, without having to take recourse to provisions that can be found in the law that governs the loan agreement, because the market would find that burdensome. They would have to take advice from lawyers to find out what the position is under the applicable law, and this would be a mixture of contractual terms and legal terms. And that's not how the market works. Loan agreements should be self-contained. That makes them very lengthy. It makes them very lengthy because you have to, as I said, to provide for every possible event that may occur in the financing. Loan agreements for a very long time followed a certain master idea how they are structured, but there were a lot of variations, basically depending on what the preference of the bank was that provided the precedent for the loan or the law firm. And that made it more difficult for people to find out quickly what the content of the loan agreement is. And so the LMA, the Loan Master, the Loan Market Association, came up with this master agreement, which had a lot of impact and is now used in most parts of the world as a precedent, as a starting point. Once we have gone through this list, we'll take a look at how the LMA website comes along and how you can see that and use them. Law firms become a member of the LMA, and membership fees are used to finance the people that take care in keeping the LMA master agreement up to date, and also developing digital masters. Of course, laws are not all the same. There are some that have specialties in the law that may conflict with some terms of the Loan Master Agreement, of the LMA Master Agreement. Very typical one, for example, for Roman law-based jurisdictions, which is basically all of Europe, is a prohibition of charging interest on interest. Many jurisdictions have that. And the reason for that was that it was to protect individuals that were in default of their loans, because if you charge interest on interest, you have an extrapolating effect on your debt. Because each time you miss an interest payment, it's then capitalized, and that makes the debt ever higher and the interest ever higher. At some point, legislators saw that this is not the way it should be, so they just entered a provision prohibiting that, and in most jurisdictions that I know, that also applies to big corporations. It's of course debatable whether this makes sense, because originally original purpose was to protect individuals, but in many jurisdictions it applies also to corporations. Now the LMA Master, developed from English law, simply provides that if there's a payment is missed, the sum not paid bears interest at the same rate as the loan, which is interest on interest. Yeah? So that would be a clause that's likely to be void if you would find it in a LMA master agreement governed by German law, so there are some workarounds. Yeah? But the number of these incidents where you have to use workarounds is usually not big. And so the LMA has drafted a few number of precedents governed by laws other than English law. There's a French law precedent, there's a German law precedent. There's of course English law precedent. And there are a few others, I think Japanese, and I'm not sure about Chinese. But I'm sure even a Chinese law you wouldn't have to make too many changes in order to make it enforceable in full on the Chinese law. And I think that's the world to come. You will see more derivatives of the original master agreement governed by different laws. And as I said, it's very successful in spreading around the world, except I think the only counter model actually is the US model. We also have a way of the US style of drafting loan agreements, which I think is not at all user friendly. When the LMA started out, it was also the English style with very long sentences and no headings and so on. And this was a very fruitful, I think, co-production by continental lawyers and English lawyers to make the LMA master agreement a very useful document because it has short sentences, has a lot of headings and subheadings, so it's quite easy to find where you actually are. You'll see that when we look at it. Or we may have already downloaded it. We go through it maybe at the end of the session or the beginning of next. But if you look at US loan agreements, they still have like sentences, half pages, very, very small print, no interspace. Yeah, I find it very difficult to read. I've been reading financing documents for 30 years, but it takes me a long time to figure out what the substance of this US loan agreement is. I don't think it's a very user-friendly document. But US lawyers are very good in making their clients dependent on them, so they produce things clients can read themselves, which of course is a good way of generating. So now what we have. A typical financing loan agreement. Yeah, following component. Description of the parties. I mean, that's quite self-understood. You would want to know in each and every contract who the parties are. Now, what parties can you think of in a major financing? The company, and the borrower, we would say the borrower. You have the borrower. You have at least one borrower. You can have many borrowers. When would you have many borrowers? Obligor is a borrower is a sub. How do you say that? A sub volume of obligors. Obligors comprises something else. I'll get to that in a second. But why would you have more than one borrower? What's a practical situation where you would have that?
If the project is too big and one contract.
Move away from project finance for a second. Just loan agreements in general. That's right. Yes, that's exactly right. You often find situations where not only the parent company can borrow, but also subsidiaries can borrow. Specified subsidiaries, not each and every subsidiary, because each borrower would be treated regulatory-wise as a full borrower, and the bank would have to satisfy its KYC requirements with respect to each of these companies, so you would have to name them up front, but you have normally a mechanism that borrowers can join and leave the financing during its term, so that's quite flexible. But yes, indeed, you would have often, if you have a big corporation, a big group, being the borrower of the parent company, would want that a few
of its subsidiaries also become borrowers, because if they weren't, the parent company would have to borrow on their behalf. The money would have to flow through the parent company and then back to the subsidiary, and that can have undesirable tax consequences, because the subsidiary would have to pay interest to the parent, the interest would have to pay, and the parent would have to pay interest to the bank, and sometimes, depending on what the taxation issues is, this doesn't really work properly. So having big subsidiaries in different jurisdictions also be co-borrowers is quite common. Now, if you would allow a subsidiary, a smaller subsidiary in a remote country to become a co-borrower, what would you actually want from the parent? What if you allow a smaller subsidiary to become a co-borrower, another borrower? If you would advise the bank, what would you ask from the parent in that case? A joint liability, yes, or a guarantee. Exactly. Yeah, because the parent company is actually the one banks are focused on, and this is where the entire value of the group combines. And so they would actually want the parent company to guarantee that. This brings us to the other concept, the other parties that may be around. These are guarantors. And it works both ways. The parent company guarantors the subsidiaries, but it's also possible that the subsidiaries guarantee the parent company. The mutual guarantee, yes, and this group of guarantors, would be another set of parties to the loan agreement. And by the way, it's often the case, very often the case, that one and the same legal entity has different roles. So when you go through the mechanics of the loan agreement, the parent company can be a borrower and it can be a guarantor, and it can be other things as well. So the role is not necessarily linked with the legal entity, but it's a role in the mechanical functioning of the loan agreement, and one entity can take different roles. But still, in the loan agreement, you would first have company A as borrower, and then it would again have company A as guarantor. So it may basically be a party twice, but that makes it better to understand. As if you would say company A as guarantor and borrower, and then you would go on and it would all mix it up. So they try to divide the roles, so one party can show up more than once in a non-agreement. Okay, now I don't want to make it too complicated, but of course on the other side, who would be on the other side? The lenders, yes, not only one lender, it would be a group of lenders, and and mechanically, well, I'm going to say that. Now, let's assume you have 10 lenders, and there is a disbursement to be made under the loan agreement, and how would that actually technically then happen? The bank, the borrower says, I need 10 million, and you have 10 lenders. How does it work?
Yeah, we want to lead bank, and there will be other banks. They will divide basically the amount among the banks. So that they will
It's about right, but would it be the lead bank? It could be the lead bank, but in what role? Remember, I said each parties can have different roles, and we have a specific role designation for that kind of work. It's all right, but what's the role? Is it really the lead bank?
The
lead bank?
arranger?
What?
Arrange.
No, the arranger is also a role, yeah, but as it suggests, it's a role in arranging.
Like
No.
coordinate between the
Agency.
lenders and.
Yes. How do you call it?
Agency.
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 It's an agent. Yeah. Can be the lead bank, can be the subsidiary of the lead bank or the arranging bank. Lead bank is not technically a term. We have the MLAs, the mandated lead arranger. That is the bank representing the bank's interest in structuring the loan, and then you have then the lead arranger is usually also the one that has the biggest chunk in the loan, the biggest part of the loan, but then you have the agency functions, yeah, and that's exactly what the agents do. The borrower doesn't want to call up 10 banks, yeah, and say, each of you $1 million, please, on my account the next day. He wants to have one point of contact to communicate with the banks, and that's an agent. So he sends a drawdown or utilization notice, or however you ever call it, to the agent. Usually 2-3 days ahead of time, he wants to have money on his account. And the agent turns around and calls up all the banks and says, I got this notice and please fund my agent account. Value date X, maybe one day before. The money needs to go to the borrower, or usually it's the same day. And as soon as the money is there, the agent forwards it on to the borrower. And the same works the other way around. If the borrower makes payment of principal or interest, the borrower pays to the agent, and the agent turns around and distributes the money to the banks in accordance with their commitment. That's what we say, commitment. Commitment here stands, among other things, for the share each bank has in the loan. This is not, if you have 10 banks, this is not always the same. As I said, the leading bank, the arranging bank normally has the biggest portion. So it can have like 10, 15, 20%, and the next layer of banks only has 10%, and the next layer of banks has 5%, for example. All adding up to 100, of course. And if I have 5%, that means as a bank, when the borrower makes a drawdown, I have to fund 5% of that drawdown, and when the borrower makes a repayment or pays interest, I get 5% of the amount paid by the borrower. And the agent is the central function, making sure the payments work back and forth, and making other things. We get to that in a second, like the reporting requirements, and then distributing the documents to the banks, and so on and so on. Now, very often there is also there's another form of agent, not just the general agency, but what other form of agency would you have? Think about the collateral. Security agent, that's very right. You would normally also try to centralize the administration of the security in the hand of an agent. That makes it easier to have banks move in and out. Ideally, the agent would hold all the security on behalf of the banks from time to time, allowing for a change in the syndicate. This does not work always because some laws governing collateral or security charges on real estate do not allow that, but we get to that when we talk about collateral. But ideally, the agent would have control over the collateral. Yeah, I think that's a very basic set of parties. You can have other parties as well. What's quite common also is you see a fronting bank. Fronting banks, you could, by the way, you can also find a project finance. Just that you have heard what a fronting bank is. Sometimes borrowers do not only need cash. It may be that they also have to hand out a performance bond, what we discussed. Now, a performance bond is not something where immediate payment is made. Ideally, the performance bond is never actually claimed, but it just keeps outstanding until it expires, and performance was proper, so, you know, nobody ever claimed payment on the performance bond. So you would wonder, you know, if the bank's not paying money, why do you put it in the loan agreement? Simple as that. Because the bank is getting on the hook. If the bank's getting a performance bond to a third party, it has to make payment if the performance bond is, if a claim is made on a performance bond. So from the bank's perspective, it's almost as good as having the money already given to the borrower. And that's why performance bond, the issue of performance bond, is treated as a drawdown on the loan in the same way as cash. And so if the facility allows for it, you have a sub-facility. It's allowing drawdowns by the issue of performance bond. Now, is it practical that our 10 banks sign the performance bond factually? Not really practical, yeah, because it would take too long. We would send around the bond to 10 banks to collect all the signatures. It's not a practical perception, so you would have one bank doing it for the other banks. And that's the fronting bank. And the bank is fronting towards the recipient of the performance bond the issue of the bond. And of course, fronting does not mean that bank has 100% of the risk if funding on the bond has to be made. No, it's backed by the other banks in accordance with their commitment. And that's why we call it fronting bank. One bank in the front, the others in the back. Could be the agent, could be the arranger. Normally, it's one of the banks that have the biggest interest in the financing that function. And there are a number of other roles, and we will. Yeah, maybe one more is the facility itself. Very often, you're not only having one facility in a loan agreement, but various facilities. Various facilities, different amounts, different functions. This can be, for example, facility A and B and C. Yeah, they can have a different term. Yeah, and sometimes you have a revolving facility. One is term, keeps outstanding, and is repaid in installments. The revolving one is for working capital purposes. Remember, we discussed that in the context of the working capital financing provided by a parent company. So short-term financing that's repaid very quickly. Now these are different facilities, sometimes different banks, but they are kept separate also in the agreement. So do not be surprised when you see facility A, facility B, facility C, revolving facility. Normally it's term loan A, term loan B, and revolver.
So the fronting bank, the relationship with the other non-banks, they are also ruled by internal credit agreements, right?
You will find the mechanics in the loan agreement. So the loan agreement does not only have
Credit agreement or loan?
it would be kind of an intercreditor agreement, yeah, but this is technically, well, this is part of the standard documentation of a bond facility that's being moved in. You find the mechanics between fronting bank and backing banks already in this element that you can easily move into the agreement. There would not be a separate intercreditor agreement. It would be part of the mechanics for the bond facility in the loan agreement itself. The loan agreement, by the way, has also other places where it has the function of an intercreditor. If you look at the agency, I told you, I just mentioned how the funding works and how the repayment works. These are all technically intercreditor terms. Also terms that if, for example, a bank happens to get money twice, it has to give it back and share it with other banks, and so on and so on. These are all intercreditor terms, but that are commonly put into the loan agreement.
Okay, but in the loan agreement, the borrower will not sign with other non-bankers, right?
The loan agreement will be signed by all
Yeah.
banks. Will be signed by all banks. Will be signed by all banks. All banks will be parties involved. All banks. Intercreditor agreements you would have between different lender groups. Yeah? So if you would have, for example, a senior lender group, yeah, and you would have a subordinated lender group, and they're not party of the same agreement, yeah, then you need to have a link between the two groups in order to effect, remember what we discussed, a going concern, in particular, the going concern subordination of the other group. Yeah, and that would be, this link is the intercreditor agreement between lender groups.
You should have a separate agreement.
Yes.
In essence, agreement, you should use Cantonese.
Yes. Now, definitions. Have you all seen one of these international loan agreements already? No? Okay. But definitions is a very important concept. I mentioned the loan agreement shall be self-contained. Yeah? And self-contained means a clear answer to every question. That means no uncertainty as to what a certain word actually means in context. Yeah? And since words are, in many cases, ambiguous, you have to give each word a defined meaning. And the purpose of that is the definition section. And definition sections can be easily 20 pages or more. But the purpose is that, when you have a defined term, you can look up the definition and then you have the exact unambiguous meaning of that term in the context of the law. It doesn't work always, but that's the ambition, that's the aspiration you have to get there. And that's why we have these extensive, very extensive definitions. In terms of proper drafting, and that's a rule that especially young lawyers often violate or breach, is definitions should not contain any substantive provisions of a loan agreement. So you should not have an obligation, for example, of one party or the other in the definition. It's just a definition. And if you want to create an obligation, then you go to the substantive part of the loan. You would not say, a report is a financial report which shall be provided by the company, blah, 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 on such and such dates. That would be a mixture of definition and a legal obligation. Proper drafting means that you separate both.
But we can refer to some definition. For example.
You can refer, well, you can refer. You can refer so that you find it. Find the right place. That's possible. That's possible. In English language, it's quite easy to find out what a defined term is because you start it with a capital letter at the beginning in violation of the normal spelling rules, and that's a signal. This is your defined term, and you can just flip to the front of the agreement and look it up. Of course, definitions are in alphabetical order, so that makes it quite easy to find out what that term actually means. In languages like German, where you have capital and small letters at the beginning, it's a bit more difficult, but it's quite common to either have a defined term in bold or italics or some other signal so that you know it's a defined term you better look at before anyone to read. Now, having a definition section is also much more user-friendly than the way it was before, because before you had the definition in the text at the time the term was first used, which, and that was also at the time we didn't have a search function with word processing, so that required quite a lot of work to find out where was that term used for the first time. And you still have that in prospectuses very often. If you read an IPO prospectus, that it's still the habit to define the term when it's first used, and makes it very difficult. So productivity progress in legal work is not very great. After the invention of word processing, that's changed things. course, the reason why loan agreements are so long nowadays is also a result of word processing. In the old days, before word processing, loan agreements had like 20 pages at maximum, because nobody was willing to type that much, and we had to retype it all the time. The first form of word processing that existed when I started practicing in the 80s was that I was dictating the text, and then I got a typewritten page, and I was trying to make as minimal changes as possible. And where I had to make changes, the secretary was cutting off the parts where I didn't make changes, would retype the paragraph, and then would use highly transparent tape and put them all together, and then use a Xerox machine to make the original. The Xerox machines, the very, very powerful copy machines, were things that already existed at the time. And I've never researched it, but I think this is actually where copy and paste comes from. Because copy and paste doesn't make a whole lot of sense on the screen, but it made a lot of sense there. So you would copy the new paragraph and then paste it on the new page and then copy. And in terms of telecommunication, there was just a telex machine. Had these huge telexes. Never seen one. Okay, description of parties and definitions. Now, commitment. I've already mentioned the term commitment to lend is when the banks sign a loan agreement. Even before they have disbursed any money, they also take on a commitment, a legal obligation. And legal obligation is to provide a loan subject to the conditions set out in the loan agreement. That's the commitment. And as I said, the commitment is spread between the banks, and the commitment also, especially in project finance, has a certain end date. So that sounds quite funny. We have a commitment, and we can use that commitment to ask for money for a certain period, but the actual repayment obligation runs much longer. Why do you want that? Well, you do not want an open commitment to hang out after the project is completed, because the loan is for finishing the project. So if it for whatever reason, very unlikely, but if it turns out to be cheaper than expected, or you have built in a certain buffer in the loan agreement to deal with contingency expenses, and those are not needed, and the project is completed, then you want the rest of the commitment to expire. Because you do not want the company to use it for working capital or whatever. If the project is finished and financed and paid, and there is money left, commitment expires. And that's why you have a certain end date, which is usually under 6 months after the completion, simply because some bills may come in later.
So the invoice is processed by the contractor, for example, that is the part of the contractor to construct of real estate or project property. So we'll process the invoice and send it to the deed bank or the bank, which acts as an agent. So then the bank will process the invoice.
Yes.
So they receive on the invoices the bank is using.
Or the invoice or the money goes to the project company, and the project company pays the invoice. Yeah, but it's must the purpose clause. Yeah, which is the next item on this list, makes very clear for what purpose may I use the loan. So the company is not allowed to draw the project loan to pay their payroll, because that would be a violation of the purpose. And that means if their CapEx, capital expenditure requirements are done because everything is paid, they can no longer use the project. Also, the company may technically make a payment like zero. Yeah, that's what we call the availability period. That's the period during which the loan is available. Yes?
I'm still puzzled about the commitment usually until 6 months after the completion. So if the company need money to complete the project, why should he lend money after completion?
Well, because not all bills may be there at the date of completion. As I mentioned, completion is defined by a performance test of the project. They will actually measure, and sometimes, I also said that last time, completion does not require that the project is 100%. Sometimes done. Often it's only 90%. It's not running at full capacity. Yeah. But that means there is still some finishing work to be done after the technical completion has occurred. Also, some bills may come late. Yeah? So that's why you need an extra period where the project loan can be used after completion. Okay, purpose that I mentioned already now, conditions precedent. There you have to keep in mind that always two sets of conditions precedent. What's a condition precedent? You can read it from there, but explain it.
Before the closing, you have to fulfill certain conditions so that you get the closing.
The closing is not the closing technically, because we talked about financial close, that's something different. But in order to get the money, you need to satisfy a number of conditions. And there are two sets of conditions, the general ones that need to be satisfied before you can make a drawdown for the first time, and then there are others that need to be satisfied each time you make a drawdown. So one is, the first set is once and forever, and that's in particular then project finance, a very long list. Remember that I said that financial close, meaning putting the structure into place, requires that all agreements are actually being signed and executed and are binding. So you would have the EPC contract, you would have the operating contract, the IEP supply contract, takeoff agreement. All these agreements would be signed and ready and would be a general condition precedent. That's quite a lot of work, can be easily 200-300 items. And they would be put together, and only once that's all satisfied, someone, law firm usually, or the agent, confirms that all conditions precedent, or general conditions precedent are satisfied. So that's step one. And now before making the drawdown, there is usually another set of conditions to be satisfied. These may be technical ones, like a drawdown notice and some other things. But most importantly are the ones that are here. No event of default and no breach of representation. We'll see later on that there will be a long list of representations. Representations are confirmations by the company as to the existence or non-existence of certain matters of fact or even law. And to be distinguished from representations are undertakings. We have these two sets, undertakings and representations. And one is just a confirmation, and the other one is an obligation to do or not to do certain things. And if the company breaches one of these obligations, it's also in default. The first one would be the breach of representation would be a representation default, and the other one would be an undertaking. And neither one must have happened in order to have access to the next level. Sometimes the documentation provides that the borrower has to confirm that each time in the drawdown. So here was confirmed that I have not breached any obligations and that all representations continue to be true as of the date. Drawdown mechanics. Now, how this is technically happened. You have a drawdown notice that is given to the agent a few days ahead of time, and the agent proceeds in the way we have already described. Now we have the interest clause. Also, that what you can read here should be familiar, should sound familiar to you. We have normally floating rate loans, yeah, and that means you have a pricing of each loan by reference to an interest rate benchmark, usually LIBOR, Euribor, and a margin on top. Euribor, LIBOR represent the cost of funding of the bank, and then the cost of the margin on top represents basically the income of the bank for taking the risk and providing the funds. Now, for how long is that interest rate normally fixed? We discussed that here, and there are a number of possibilities, but in the market, for financing like this, you usually only have two different terms. It's 3 or 6 months. And these are the ones that are practical, because if it's shorter than 3 months, it's a lot of work. You have to reprice it all the time. And for longer than 6 months, you almost getting into long-term funding market, which is a totally different market. Now, the 12-month Euribor/LIBOR is not a very liquid market. Yeah, the liquid markets are 3 months, 6 months. That's the second question. Hedging is another point. You can have a hedge agreement or a swap, interest rate swap with someone else or one of the banks, but you're just talking about the loan agreement. That would be a floating rate loan, and the interest rate would be priced at the choice of basically the borrower. The borrower is given the choice whether to choose an interest period of 3 months or 6 months, and then it will be priced in accordance with 6 months Euribor or 3 months. Another reason, yeah, as I said, this is the most liquid market, and it's also the most liquid market hedge-wise. Yeah. Of course, on a hedge for 3 months, a 3 months Euribor would be something like, I don't know, 3 or maybe even 5 years fixed rate, yeah. Depending on how long you want to fix that.
So the hedging party becomes a party to the interchange agreement.
Yes, indeed, the hedging counterparty normally becomes a party, not because of the cash flows, but normally in relation to the collateral, because we want to make sure that also the claims on the hedging agreements are collateralized. Because if the company goes bankrupt, we would normally say, okay, it's a hedging agreement. There is no risk, because each time the hedging bank pays the fixed rate, the hedging bank pays the floating rate, and the borrower pays the fixed rate. Where's the actual risk? That's right. The interest rate can change, yeah, so that the cost of entering into a similar swap would be totally different. And since even the hedging bank would normally not have the whole risk on its book, but would have turned around and hedged itself. Yeah? And that implies that it has a certain cash stream to satisfy its own hedge. And if that falls away, there may be a cost involved in that. I had once a case that's quite interesting. It was a supplier for Airbus. They made the toilets actually in Hamburg, and they had costs in euros and income in dollars, because the aircraft business is all charged in dollars. So they had long-standing hedges to hedge their dollar income, or to hedge their euro expenses against dollar income, and they were doing this always for a long period. And then all of a sudden, the hedging bank went bankrupt. And what you have in these hedging and derivatives agreement is that you basically you end them out, yeah, and then you have a netting amount. You liquidate the position according to market value. And the reason was, their hedge was because it was deeply out of the money, so their hedge had a lot of value for the bank, and all of a sudden the poor little company had to pay a huge amount to the bankruptcy administrator, because their hedge was ended, and they couldn't actually afford that. They had to go out to the market and borrow to make that payment. But you can see that if you have long-term hedges, particularly in currencies, there can be huge tension in the agreement. If it comes to an unexpected ending, that may result in huge liabilities from one of the two sides of the hedge. And those need to be collateralized as well. Okay, then you have, of course, a repayment clause. In corporate lending, often you have a so-called balloon payment, that is a term of the loan, and that is ended at a certain time, and then the entire amount is repayable in project finance. That would not be appropriate because banks would want to avoid that the project company is sitting on a piling, on an increasing pile of cash in order to save money for the final day. They'd rather want to have regular installments being made in order to decrease their exposure. So you would, depending on what the cash flow projections are, have repayments. Normally say my. Now, prepayment and cancellation, why do I need that? Well, the reason is basically for the borrower to manage the cost of its loan. Let's assume the project company the project's running better than expected. There is no, project company may not find it very useful to have a lot of money on its account, not getting interest for that money, but still having to pay the expensive project loan. In that case, or for that case, loan agreements always, I think, allow for prepayment. So the project company can make extra payments faster than the 6-monthly installment in order to reduce the loan. How would you, if you have a list of installments, like every 6 months I have to repay 10 million, and now I make a prepayment of 10 million. How is that applied to that schedule of installments? What do you think? To the end, that's right. It's not applied to the next one due, because that would mean the banks are losing a bit of control whether they can actually make the payment, because if you would just prepay the next installment, that might mean the company has not to make any repayment for the next 12 months. Banks don't like that. So it's always applied towards the end, or as legal language would say, in the inverse order of maturity. That's not easy to understand, but that's actually what it means. And it's applied in the inverse order of maturity, meaning it's applied to the longest installment maturity of the loan, thereby making the repayment shorter. Not leaving it the same, but making it shorter.
Could you spell the
Inverse. Inverse order. INVERSE. Inverse order of maturity. Cancellation is the same concept as a prepayment, except we reduce cancellation for the commitments. Here again, we have the situation that the project company has a certain amount committed by the banks. That commitment will expire 6 months after completion, as we discussed. But the project company, for one reason or another, already knows a year ahead of time that it's not going to need the entire amount, but it has to pay for the commitment. Remember, commitments cost also money because the banks have a cost associated with it. And so the bank wants, so the borrower wants to get rid of this extra cost. It can cancel the commitment. It can just send a letter and say, we hereby confirm we don't need that amount anymore. Please cancel your commitment. And if the project norm with moving case allows for early cancellation, now the banks will just distinguish that commitment and will stop charging the commitment interest. Now the prepayment I've just explained is voluntary. It's something the company can do. There is an equivalent on the other side. It's a mandatory prepayment, where the agreement requires the project company to prepay the loan. That is also the case when there's cash piling up. The project company doesn't necessarily need. In that case, you would have often a so-called cash sweep provision. If there's extra cash, the project company must make a prepayment. Or you have an extraordinary event where the company is getting, for example, as compensation for damages incurred, a huge amount of money. And the banks will want to have their hands on it by requiring the company to make a prepayment of that. A typical case is an insurance claim when there is a total loss, but sometimes you have an insurance from a fire maybe, and normally there are two ways. Either the company uses the insurance money to rebuild it, or if they think, the project was too big anyway, we do not need that building, then they have to get the compensation and pay it back to the banks. Because the banks have lent to finance the entire project. If parts of the project fall away because of a disaster, the bank has the right of the money is given to them. Now, this is a complicated issue, margin protection clauses. That's a complicated issue. Try to make it as easy as possible. As I explained, banks make their money by adding a margin on their cost of money. That's how they make it. Now, normally you would think that it's the bank's risk actually if the legal environment changes. But that's actually not the way how the market works, because the banks have, for good reason or not, for a long time always argued, we are just paid for taking the risk of repayment, but we do not give you, borrower, an insurance for the regulatory environment. We can't do that because often regulators raise costs here and there, and that interferes with our calculation. We cannot consume that, which is kind of strange because normally the calculation of a price is the sole responsibility of that offering a price. But that's not the way it works in the funding market. And so there are a few provisions that are meant to protect the originally agreed margin by the banks. And that protection is financed by the borrower. So in other words, the borrower's cost can go up if one of these protection clauses becomes operative. Now the first one is the tax grosser. Has everybody ever heard of tax grosser?
If the tax change, which is not good to the lender, to the bank have the right to let the lender to bear the cost.
Yeah, that's exactly right. And there are many circumstances where this can happen, but the most typical one is the following. When you have international financial transactions, international meaning you have borrower and lender in different jurisdictions. you always have to think about taxation. If two countries are involved in a transaction, the two countries may think of taxing the benefits of the transaction one way or another. And if you have a borrower and a lender, and you think about interest as income, there are two ways of looking at it. The state where the lender sits might say, this is income that the bank gets from lending out money, and of course that income arises where the bank is located, so in other words, in the bank's country. Now the country where the borrower is located might say, no, this is not true, because that interest is basically earned where the borrower sits, because it's paid from the profits in that country, so we want to tax it. And there's no right or wrong, just two different ways of looking at it. What's common in the international financing market is, or the common view is that actually interest is taxed in the bank state. So not the second view, but in the bank state. And by the way, this is different from the question whether the borrower can expense for tax purposes the cost of interest. That's always very clear. Because where the state of the borrower claims taxation, this will be taxed of the bank and not of the borrower. But how can the borrower's state claim taxation from the bank? Because the bank would never do it voluntarily, go there, file a return and pay. And the tool is withholding tax. It would require the borrower to make a withholding from the interest and pay it to the tax administration of the state of the borrower. But that would be not a tax of the borrower, it would be a tax of the lender.
But it's borrower's obligation to take whatever money comes.
But it's the borrower's obligation to take that money.
Okay.
Because the taxman at the lender's office, the lender's state knows the borrowers would, at the borrower state knows the lenders wouldn't do it themselves. But that's a withholding taxation. Now you could say, okay, well that's the bank's risk. They should then file for a reimbursement or whatever. But that's not how it works. The way it works is that it's always assumed interest can be received without withholding tax. And if that changes, the borrower has to compensate that change. And that change is compensated by what's commonly called a gross up. And a gross up means the borrower has to pay so much more interest that after deducting the withholding, the amount is the same as it were without the withholding. And that can, if the withholding is 20% or so on, this creates a very significant extra charge. And as a compensation for that risk, the borrower then may step out of the loan agreement and may terminate it. Of course, that's theoretical in project finance. You may not find any syndicate. And that's why there's normally an obligation to cooperate. If this is just an issue between that specific constellation of jurisdictions of the lender and the borrower, the banks may be able to move the loan to another jurisdiction that's more friendly, because the rules are always written by what we call double taxation treaty. That's a confusing term. I think it should be treaties for the avoidance of double taxation, but everybody talks about double taxation treaties. And these double taxation treaties set out the rules for exactly what I said. And in the general OECD model double taxation treaty, there is no withholding tax, because taxation is not for interest, because taxation is referred to the same amount for interest. Different, by the way, for dividend.
Dividend income is deemed to have been made in the jurisdiction where the company sits that makes the dividend. So it's the norm that dividend income is subject to reporting tax before it's paid to the shareholder outside of the jurisdiction, but not for it. So that's the first clause. Now, increased costs. That's a similar concept, but that relates purely to regulatory costs. I explained to you that banks need to have a minimum amount of capital in order to buffer the risk on their asset side. The risk on their asset side is basically represented by the risk that their borrowers do not repay their loans. If they do not repay a loan, they make a loss. Now, we've already learned a little bit about balance sheets. When a bank has to write off a loan on the asset side of the balance sheet because the borrower goes bankrupt, what happens on the right side?
Reduced reserves.
Yeah, it immediately reduces equity. You know, however you apply it, whether it's reserves or premium or whatever, but if you report the loss, that's immediately reducing equity. So equity is going down if you make a loss. I mean, that's the mechanics of a balance sheet. Yeah? And that explains why equity is necessary to buffer the risk of the bank. If there's not enough equity, yeah, losses will immediately lead to a situation where the bank can get into serious trouble because equity is just evaporating. And that's why banks have a minimum amount of capital. That's not high anyway. You know, before the financial crisis, everybody had like 8%, 10%. Now the big banks have 13, 14, but you know, a bank like Deutsche Bank has a 1.5 trillion dollar. So now you know, having like 14% equity against that, it's not a huge amount. There are a lot of things that they can happen. So it's small enough, yeah. But it has a cost because the equity also needs to be financed. You either have subordinated instruments, you have to pay high interest rate on that, or you have traditional share capital, and investors expect a dividend on it. So there's a cost to capital. Because banks are always tight on capital, they always have to think about to make good use of their lending capacity on the asset side. They're the best use that they can get. Yeah. Now, if these terms all of a sudden change and the cost of capital is going up because, for example, minimum capital is raised because there's another crisis coming up or whatever, the whole calculation, you know, may become totally irrelevant. And in that case, the banks have a right to recalculate the loan and set a new margin. That is, I think, the principle of that. Of course, it never exists in that pure form. I mean, the first thing the borrower that's advised by a good lawyer like you will say, you know, well, this does not apply to anything you already know today, yeah? or that's already visible at the horizon to occur in the next few years. So there's always negotiation. You know, the things that you already know are carved out. Yeah? That's normally acceptable for the banks because even if they know the costs going up in 2 years, they have the chance to make their calculation on that basis. So it only covers things that were totally invisible at the time that all of you were on the side. But even then, it's not very often used because it results in a huge discussion and a huge controversy about the amount, the cost, the calculation, and so on and so on. So it's not a very practical clause, but no bank would ever agree not to have it. Another last one is market disruption, and that becomes very practical at the moment. Market disruption
simply put means the whole LIBOR-Euribor concept does no longer work because there is no interbank market anymore. I cannot refinance my loan the way I used to. Why is it very topical? Because as we said, Euribor and LIBOR are phased out and the market does not yet fully know what the replacement is going to be. So there are clauses that allow for this transitional period. And the last way, if nothing works, is always cost of funding. LIBOR is a standardized assumed cost of funding. Yeah? But if you go to individual cost of funding, that means each bank can just go to the borrower, listen, the market is down, we had to shop around everywhere to fund the loan, and this was the actual cost that we have, because they can be very high. And especially when the bank is a small bank and doesn't have good credit, it has a very high cost of funding itself. And then you have the margin on top, that can be a very big amount. But that helps the bank to survive. That their own cost of funding is to be absorbed by the borrower in periods of market turbulence. So that's what we call margin protection clauses. Something similar is the egality clause, basically giving the bank a right to go on, move on the financing early, ahead of maturity, if it becomes illegal for the bank to continue being a lender. When is that relevant? I think it's primarily relevant in the case of sanctions. Sanctions become more and more popular. It's an advisory business that in my firm has boomed over the years because you have more and more conflicting sanctions. Think about Iran, where Europe wants to keep the Iran atomic deal and the US has terminated the deal, and the US is penalizing all companies that still deal with Iran, whereas Europeans have another view on this. They're very difficult. Very difficult. So you're really between a rock and a hard place if you're dealing with Iran. And then there are other cases like this. In the past, Cuba was basically the only case where the Americans really had set their mind on Cuba sanctions, where the rest of the world didn't care about it. But Cuba wasn't, it's not a big economy, but Iran is much. Representations, briefly touched on, a statement of fact or law. The list is long. 10 pages is nothing. Often you go from A to Z, and then you start again with double A, and then you go on to double Z, and then you start again with triple A or whatever. The letters of the alphabet are normally not enough. So better use numbers. It can be very long list, and it will be very specific to the business. I have all licenses and so on. Very, very business specific. Now, young lawyers often say, what's it good for? If it's wrong, it's wrong. What can the banks do? Right, that's a valid thought. But think about it as a checklist. A borrower that's a well-managed borrower will go actually through that list each time, and thereby maybe all of a sudden noticing or remembering that one of these representations are no longer true. That doesn't mean a bad answer to that is just ignore it or hide it or lie. A good way of reacting is talk to the banks and say, I have this problem, because the banks would want to know. And there's normally a solution. A rep default doesn't necessarily mean that the loan is terminated. It's the size of the fault. But it's a good checklist. Now we're getting to another very, very important point, and that's financial ratios. Financial ratios is already a subheading of the other big section that's covenants or undertakings. We have representations, statements, and then we have covenants and undertakings. And in the covenant section, we have three different subsections that are commonly distinguished. The first is financial covenants, the second is information covenants, and the third is general covenants. Now, what's a financial covenant? Can anyone explain that, or without reading it here? Well, a financial covenant is an undertaking by the company to make sure that certain financial ratios are kept in a certain band. What's a financial ratio? A financial ratio is a set of parameters that measures how the company is doing financially. Yeah? And the oldest and most generic financial ratio would be debt equity. Yeah? That's very, very easy to measure. I look at my balance sheet total on the left side. Yeah? And then I look at the equity on the right side, and I have my debt equity. So if my if my equity is 20%, I have an equity ratio of 20%. Yeah. That's the leverage or the gearing. That's the debt equity ratio. Is the debt equity ratio really useful in project finance? No, it's not useful in project finance. We are focused on cash flow, yeah, because we want to know not how the gearing of the companies is also relevant. I said at the beginning, 20% equity is something that you would want to see, but the real relevant issue is cash flow. Yeah. And cash flow, on the one hand, should have a certain good ratio to debt service. Yeah? You would want to know how much cash is there and what's the debt service on the other side. Yeah? And debt service is interest payments, but also scheduled installments, scheduled repayments. That's the debt service. And you would want to compare, what's the debt service and how much cash is there. And of course, you would want the cash number to be sensibly higher than the debt service in order to be on the safe side. And that's what we call the debt service coverage. It's the ratio of cash flow to debt service. And how do you measure it? That's a big question. Of course, since you are looking at debt service and cash flow in certain periods, it's very clear you need to measure it in periods. Debt service cover ratio is as distinguished from the other one we look like in a moment, is a rather short-term yardstick. Yeah. You can measure it backwards looking, which is not that interesting, because if you know after the fact that there was not enough cash flow for debt service, you may know it earlier than that by just by default. So you try to measure it forward looking on the basis of projections. But these projections, of course, are somehow based in the past, otherwise you can't. But it's forward looking. And the period to which you look forward normally is a year. So you try to project how much cash flow is there in the next 12 months and what's the debt service in the next 12 months. And you look at the revenue side of the company, you look at the expenses, they have and so on to form an expectation of future cash flow. Now, do you measure it only once a year? No. It's measured more frequently. It's normally measured every quarter. Yeah, but always for 12 months. Yeah, meaning, if you measure it basically on the 1st January, you look at the period until the 31st of December. Now, next measurement is 1st of March, and then you look at the period until the 28th of February, sorry, until the 21st of March in the next year. Yeah? Sorry, 1st of April. Yeah. And then you measure it on the 1st of July, and you look to the period to 30 June in the next year. Yeah? And that's what we call it. That's what we would call a rolling 4-quarter. Yeah. Always looking on the next 4 quarters, but on a rolling basis, not on a calendar year basis. And the loan agreement will have an undertaking to the borrower to make sure that debt service cover ratio will never be worse than, let's say, 1.2. Yeah? Meaning that these projections for the next 12 months, rolling quarter period, cash flow is at least 150 or 200% of debt service, of expected debt service. The funny thing is, how can a company undertake to do that? It's probably beyond its control. That's true, it's beyond its control. So it's just a technical tool to use this undertaking to construct a breach of the agreement if the undertaking, if the debt service is worse than the bottom line. So there is a covenant breach that would allow the banks to get busy and either terminate or negotiate or adjust or refund or go to the sponsors, ask for extra cash or whatever they want to do. Yeah? So it's an undertaking to do something which is beyond the control of the company, but it's an established concept to do that. And now the other one, which is more a long-term financial ratio, is the loan life cover ratio. And the loan life cover ratio is trying to measure whether, simply put, the project is actually worthwhile to be done, because it basically measures whether the return of the project justifies the amount of the loan by looking at the discounted cash flow to the life of the project or the loan and taking the discounted cash flow in proportion to the outstanding loan. And if it turns out that the discounted cash flow in the next 7, 8, 10 years is lower than the amount of the loan, you could probably pack your things and walk away, because that's, then the whole thing is not worthwhile being done, because the project does not make enough money to repay the loan, let alone to amortize it, because equity is a buffer. Then it's really a bad project. So you would expect a higher number of at least 2 times or so in order to be on the safe side. And that can be measured in briefer intervals, but it's long, we often also measure it. But it's a very, very long term, and it's therefore also calculation is not very certain, because you have to make a lot of assumptions and factors and so on. It's also very common in real estate finance, by the way.
Normally, who will do the calculation? It's higher by the investment bank, higher by the bank side, or the project company?
Sorry, I
So who
didn't
will
get
do this calculation?
Well, who does it? The project company does this calculation, and they give it by way of a certificate. The project company will have to confirm every quarter, the numbers, and they sign it. The managing director sign it and give it to the bank.
Like the loan life cover ratio, would there be any manipulation, because it is the project company themselves doing it?
It can be a manipulation, of course. It will be fraud. It will be credit fraud. So it's quite a high threshold for the managing directors of the project company just to sign a document to commit credit fraud. I think there is an incentive to be honest, because otherwise they go to jail. You know, if someone can prove that they manipulated the calculation. Even that?
Because I haven't imagined that this thing is serious enough to go to jail. Because I think it's like a fraud on the contract or on the civil law, just to pay the damage.
No. That's really funny. If you make a willfully wrong calculation, that's fraud. And fraud is a criminal offense.
How to determine it's a fraud versus like financial things based on fraud?
I thought maybe I misunderstood your case. I thought the managing directors manipulate the calculation.
Just assumption, just like
Well,
some technique.
a willfully wrong assumptions is manipulation and that is fraud. If they're just wrong with the assumption, of course, they cannot be held responsible for that.
They can like deliberately to choose those more optimistic assumptions.
Well, they have to tell the banks what the assumptions are. They have to disclose it. It's not just because they have to disclose the calculation, and so they have to tell the banks, for example, what the expected discounted cash flow is, and the banks can't question that.
The biggest way I think that calculation is like cooperation between the bank and the bank.
Yeah, I mean, they have the obligation to, because they are closer to the business, they have the obligation to start the process by submitting the certificate, but they have to disclose the basis for their calculation. And if that's honestly held, and they tell the banks all the facts in which that base, that's of course not fraud. But if, for example, they positively know that the expectations regarding future cash flow are lower than what's in the certificate, that's fraud. Right?
How to prove that? It's very hard to prove, I think, in another case.
Well, because they have market data, they know the output of the company. They have to, of course, possible that they make a willful mistake. That is possible. But normally the process is designed in a way that they take the banks on board and both discuss that with the banks, saying, okay, these are their assumptions, and they are of course.
One more question, Professor. You have mentioned the representation is only a checklist for the borrower, but under general law, is it a liability without fault, and if there is damages in the misrepresentation in breaks and warranties, can the lender claim the damages over the borrower due to the misrepresentation?
The first question is a very, very good one. Whether they can create a liability without fault. That's why it's normally worded as an absolute guarantee. And if you give an absolute guarantee, like financial covenant, fraud is not relevant. Documentation makes that normally clear that it's not necessary for the banks to prove that the borrower has acted negligently or gross negligently or even willfully in giving a wrong representation. It's an absolute guarantee of the fact. So that always creates then a secondary claim if that guarantee is breached, and that but the actual damage claim is not it's not so much actually in the focus, because the documentation has rules for that. And of course, they can terminate and ask their money back, and they can ask for broken funding costs, where they've heard that, but the banks refinance themselves, so if they get their money back early, they may have refinancing costs still outstanding, and that's a damage they have, and then they get broken funding costs. They would normally not get foregone profit. So that would be ruled out by the documentation, that the banks could say, if that would have been right, we would have had a successful project finance for the next 5 years, so we would have profit for the next 5 years. It's just a negative interest. They get out of it, and they are just made whole and get their money back. All bills are paid,
the books closed. All right, then we didn't get far enough, so we continue with the loan agreement next time. Can I get the attendance list? Yeah. Thank you.